as a quick review, remember we're talking about the financial markets. We're talking about kind of the role that they play in the US economy. We talked about some of the major laws. We talked about some of the major types of securities. And I think we got through mutual funds. We're almost done with mutual funds. Is that right? Anyone? Bueller?
Yeah, I think we did some on mutual funds.
Okay, thank you. All right, and then we'll finish that up, talk about a couple other securities briefly. Then we'll talk about primary versus secondary markets, some investment strategies. We're not going to make you all millionaires today, but we're at least going to introduce the topic of investment strategy. And then we'll finish up with the different parts of a stock quote. So that when you guys look up a stock quote, you'll be able to make some sense of it. Okay. All right. So remember, financial markets are transfer money from savers to borrowers. And by savers, you might put in parentheses in your notes, pardon me, investor, right? Because you're buying some financial securities in an effort to grow your money. So you are investing your money. You're not just doing it for fun, right? And by the way, most of us, maybe not now, but you will be an investor, believe it or not. Here's what I mean by that. If you have a 401k, you guys stay in school, graduate, get your whiz-bang job, you will have a 401k, most likely, right? That means, so, and we'll talk about this more next chapter, but you can elect to have money, a percentage of money, like 5% or whatever of your paycheck, pulled out of your paycheck automatically every month and invested in the funds, different types of mutual funds that you elect, and we'll talk about that. Boom, you are at that point an investor. You have a vested interest in what's going on in the financial markets and in the economy. If you have an individual retirement account, which I beg you to do as soon as you graduate, in addition to your 401k, we'll talk about that next chapter, okay? You are definitely an investor. Okay, so you guys have a stake. You hear on the news, you know, Wall Street fat cats. Politicians love to say that. The Wall Street fat cat. That's BS. It's just vitriol. All of us are investors. All of us have a stake in what's going on in the economy and in the financial markets, because that's what grows our retirement income. Okay, so. And the borrowers, of course, are the companies, the corporations, or the governments that need money to finance stuff like, remember, payroll, new facilities, new products, just to compete in global markets by coming up with, you know, being able to open up facilities overseas, maybe developing new international distribution channels. All that stuff takes money, right? Also, governments, remember, they use the financial markets to raise money to build things, like Waco did a municipal bond to develop that area downtown. So understand that a whole lot of us are involved in this process. All right, remember depository institutions, we're all aware of them, right? Commercial banks, we're all familiar with. Credit unions are actually owned by the owners, remember that, and the fact that they are a nonprofit. And then savings and loans or savings banks, those focus they make most of their loans as mortgage loans. Understand that there's a big mixture between these three these days. Then you got non-depository institutions. We talked about that, right? Institutional investors are like your mutual funds, pension funds, things like that. You know that you and I can't actually invest in financial securities, can't buy financial securities. You've got to go through a broker. Those crazy people, you know, on the floor yelling, setting the markets. We go through trading websites, use trading apps. Those are a type of broker, right? We'll talk about the difference in the types of brokers in a second. Securities dealers are just people who make their money by, buying securities and selling them, hopefully at a lower price than they paid for it. And they make money off the spread. So if they buy something at 15, they're hoping they can sell it at 18 or 20, right? And they make their capital gain off that spread, and there's a capital gains tax. If you buy a security and it just keeps going down and you dump it, you sell it, or make a trade, that's what you hear that term, I don't want you to be confused. When you are buying or selling a security, you are making a trade. Make sure you guys understand that. So if you buy something at 15 and it's just going down, 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 and you're like, oh crap, you sell it at 12, that's a capital loss, right? So understand that's what a capital gain is. So securities dealers do that for a living. Like day traders will do that by the hour. They'll buy a stock in the morning and maybe sell it at lunchtime. They use sophisticated software to help them, kind of figure out, guess better about when to make these trades. You can also lose your shirt doing that. So don't let anybody convince you it's easy money, and if it was, everybody would be doing it. Investment banks, remember, those are banks that specialize in helping companies go public, right? To initially sell shares of ownership in their company, sell stock, right? So it's initial public offering. Remember, an IPO takes a lot of really specialized knowledge, and it's very expensive. So investment banks specialize in helping people do that. Remember, investment banks are typically owned by a bank holding company that also owns commercial banks. All right, some of the big laws. Remember, Federal Reserve Act, as you might guess, established the Federal Reserve System, the bank for banks, the bank for the United States government. And remember, when we're talking about finance or the economy in Chapter 2, we know that the Federal Reserve has a lot to do with regulating our economy by either taking actions to grow the money supply or shrink the money supply. Remember that? Well, it was established with this law. Banking Act of 33 established the FDIC, very important, right? That prevented runs on banks, super important. Securities Act 1933 established the Securities and Exchange Commission. Let's see, SEC. Another big one, the Banking Act of 1933. You got to tell the truth. Sarbanes-Oxley tried to tighten things up a bit after a lot of financial scandals. Dodd-Frank in 2010 as a result of the financial crisis of 2008. Also the Modernization Act of 99 established ATMs and direct deposit and online banking. That was huge. All right, we talked about the basic types of securities: common stock, preferred stock, bonds, and then convertible securities. It's not really its own kind of security. It's really a type, it's a preferred stock or a bond that has a convertible feature. Make sure you understand that. I don't like the fact that the book tried to make it sound like it's its own entity. It is not. Okay. So remember, common stock is the most common type of ownership in a company. It's not a trick question. Okay. You get to vote. If the company declares dividends, you get a piece. We want to keep you whole. So if you own 5% of the company and we decide to issue additional shares of stock, we're going to offer you enough of the new shares of stock. Well, you got to buy them, but we're going to offer you the ability to buy enough shares of stock to keep you at a 5% owner. Okay. What else? Preferred stock, you don't get to vote. But if the company goes under, you get paid first before the common stockholders. You're going to get dividends, but probably at a lower level than common stock. you're also, since common stock does this, right? It's very volatile and you can make a lot of money off the peaks and valleys, right? But preferred stock is more like this, right? It's more steady. So in a way that's good. It lowers your risk, but, and it's a little more predictable, right? You're going to get, you know what your dividend is going to be if the company pays them out, and you're going to get get those dividends at regular intervals. That's all awesome. But the thing is, since it is not as volatile as common stock, you're not going to make as much money off the capital gain. Okay. Like you're not going to be able to buy really, really low and then, or buy low and then sell really, really high. Then the margin is going to be really, really low. Okay. All right. And remember, companies don't have to pay dividends. They don't have to. They can retain earnings if they need to. All right. Remember, bonds is essentially the company or the government getting a loan from you, the investor. That's what a bond is, right? Remember the dollar amount you buy it at, the new bond. That's important. The dollar amount of the new bond, brand new bond that is just now issued, that amount of money is the face value or par value. Now, if it's resold later, the par value is going to be, it's going to be below, most likely, that amount. It could be above, right? If it's above par value, you're buying it at a premium. If it's below par value when you buy it, you're buying it at a discount, right? And that can happen because based on what's going on in the economy. Just know that and you'll be good. All right. Remember, coupon rate is the interest rate you're getting on that bond. And unlike stocks, you don't have ownership in the company, but the company that issues them, or the government, is legally required to pay you the coupon rate, the interest rate, at regular intervals for the life of the bond until its maturity date. In other words, if it's a 10-year bond, well then from the date of issue, exactly 10 years from then, boom, that's the maturity date, no matter when you buy it. Remember, because people can sell a bond before it matures. If you buy a 10-year bond, you don't have to hold it for the whole 10 years. You can sell it out on the secondary markets, right? So if you buy it at, say, 5 years in, right, most likely you're not going to be able to buy it at full par value. You're going to buy it at a discount, right? You're going to buy it at a lower price than the par value. Okay. All right. And remember, current yield is some really difficult math. Remember, I told you the math in this class is going to be real easy. Okay. Par value is an example. All you need to do is take the dollar amount of annual interest divided by the current market price for that bond. Boom. That's the yield. Too easy. All right. So remember, prices fluctuate in the bond market based on what's going on in the economy. If you buy it at above par value, you're buying it at a premium. And sometimes, you know what, you might do that as an investor, because you might be like, you know what, holy crap, this bonds are returning are a safe investment right now, and they're a fairly decent interest rate. So I'm going to go ahead and pay more than the par value because it's a safe place to park my money right now. If you buy it at a discount, you know, you're getting that's usually what's going to happen. You're usually going to buy it. Okay. Remember, convertibles is not their own entity. It's either a bond or it's preferred stock. Okay. It just means that at some point you can trade your bonds or preferred stock for so many shares of common stock if you want to. For example, and when would you want to? You know this for the test, right? If you're cruising along, getting your little preferred stock dividend, right? And meanwhile, the company's common stock starts going through the roof. Holy crap, I'm missing out. I'm going to exercise my convertible feature. I'm going to trade my 100 shares of preferred stock for 70 shares of common so I can ride this train. Okay, you are exercising the convertible feature. That's kind of how that works. But opposite situation. Let's say that you're cruising along, getting your little preferred stock or bond interest, coupon rate, either way. You're cruising along, getting that little bit of money every few months. Meanwhile, common stock for the same organization, the same company, or, well, it would be the same company, starts going down. I mean, it's just tanking. What are you going to do? Nothing. Absolutely nothing. Hold what you got. Keep on getting your little bit of money and let the common stock people suck eggs. Okay? All right. Mutual funds. Remember, a mutual fund, you're essentially buying into a fund that is diversified. It would be really expensive for you and me to do that, right? Because you have to buy a bunch of different financial instruments and a bunch of different sectors of industries, sectors of the economy. And that would be really expensive for you and me. But a mutual fund pools money from a whole bunch of us. And then they have the money to do all this diversification, right? And then we can just buy a share of the whole thing. That's what a mutual fund is. You are mutually buying into a diversified portfolio. Okay. All right. So it's professionally managed by people that know what they're doing, hopefully. And how do you know if a mutual fund is managed well? Just look at its history, right? Look it up. Whatever the name of the fund is, it might be called the Pacific Rim Fund. It might be called the Corporate Growth Fund, whatever. The Optimus Superman Fund. It could be called anything, right? Look it up online. Go to any financial website and type in that search term, or heck, you can probably just put it into Google and look it up, and you can look at the history of it and see how well it has performed. What kind of interest rate has it returned? What's the return on investment over time? And you'll get you can see a little chart and everything, a little graph. Like if it averages, 6, 8, 10, 12%, you've got to buy it based on risk, though. Remember, we'll talk more about that in a second. Because some of the funds that have returned a lot of interest, you'll see in some years they tanked. So depends where you're at in your life. All right, it's easy to get your money out of mutual funds. You just withdraw it. There's different types, though. How you withdraw your funds depends as to whether it is an opened-end fund or a closed-end fund. Make sure you know the difference. Okay, so in an open-end fund, it has it does not have a fixed number of shares, nor are its shares. They can't be traded like stock. Okay, but in a closed-end fund, it's the opposite, right? You've got a fixed number of shares, and a fixed number of shares, and the money you get from selling the shares can be traded, or your shares can be traded just like stocks. Make sure you're clear on the difference between those two. All right. A couple of things I want to just kind of summarize on mutual funds. So you can diversify at a really low cost, professionally managed. I made the summary. I added the summary slide for you for the test to help you out. It's easier once you get your money out. Make sure you know the difference between open-ended and closed-ended. But either way, you can get your funds out pretty easily. In fact, I probably should have indented. Let me do that right now, doggone it. I'm doing it. I'm gonna fix something for you. Stop it. Right there. All right, let's. Boom. I think that's the best way to think about that. There we go. All right. So professionally managed, easy to get your money out, but it depends how you get your money out. Depends on whether it's open-ended or closed-ended. Because in an open-ended fund, if you want your money back, you're selling it back to the fund. If it is a closed end, you're selling your funds out in the markets. Make sense? All right. Let me make sure you guys are clear on the difference between those. All right. Why is this going backwards? Okay. All right. On the downside, yes, you've got some fees. Like 1 to 3% sounds bad, but it's not really that bad. I would say it's still worth it. Can you imagine trying to juggle all those different funds? It would be you'd have to really be into it. So it's worth it to pay 1 to 3%, I think. Yes, there are some tax implications. What we mean by this is, remember I talked about capital gain and that there is a capital gains tax, right? So if you buy one stock at this price and sell it for this price, you made a trade, right? You got to pay a tax every time you do that. So every time you make a trade and you receive a capital gain, you pay a tax. All right, so imagine if you buy into a mutual fund where the fund manager makes a ton of trades all the time. Well, that's going to be ramping up. It's a microscopic percentage when you really break it down per trade, but still, if they make a whole lot of trades and make a whole lot of capital gains, you're going to pay more and more tax. Now, again, it's worth it, right? Even with the management fee and the taxes on capital gains, you're still making a lot more money, most likely, than just putting your money under a blanket, under your mattress, or sticking it in a savings account, or buying treasury bills or something like that, a cash equivalent, right? So mutual funds, I still say are really good. Now, some funds aren't as diversified as you might think, so do research. Okay, you want a diversified fund, but you know what? If I say it's not necessarily a downside if the fund historically has been making pretty good money. Hey, I don't care if it's diversified at all if it's making money. All right. There's also this weird animal called exchange traded funds. All right. So exchange traded funds are essentially pieces. They're kind of similar to mutual funds, but you're buying into a market basket of a lot of different securities, which is similar to mutual funds. But the market basket really reflects some stock indexes. So it's more of a standardized type of investments that you're buying into, but it's still, pooling funds from a whole bunch of different people, and you're buying into it. You're buying a share of that fund. And then anytime you want, you can sell your ETF shares, just like stocks, out on the markets to other investors. You don't sell it back to the fund. All right. All right, let's talk about doing those IPOs. IPOs would be sold in a primary market, right? You're selling your shares on the market because those are newly issued securities. Now, please pay attention to what I'm going to say right now, because I don't want any of you to get confused and miss this on the exam, okay? Let's say you are a big company and you decide to go public. What kind of an institution, first of all, what kind of an institution are you going to go to for help in organizing your IPO? Anyone? An investment bank. Thank you, Steve. An investment bank, right? Which is a non-depository institution. So you go to your investment bank, they help you organize your IPO, and you sell your shares, your newly issued shares for the first time your company has ever done it, right? Those shares are going to be sold on the primary markets. Now, here's where the tricky part comes, right? All right, so let's say that later on, maybe 10 years down the road, the company decides we're going to issue additional new shares of stock. Where would they be traded? Still here. It would be sold on the primary markets, because the primary market is where you sell newly issued shares, whether it's the first time the company has ever issued shares or not, or the 50th time, right? If they are brand new shares that have never been traded before, they're brand new, they are traded on the primary market, okay? That's not where you and I are probably gonna get to buy. That they're not available on the New York Stock Exchange, right? How are they sold? Well, sometimes they are. Sometimes they can be issued on the exchanges, but I would tell you most of the time, they're private placements. That is, it's a select group of institutional investors or private individual investors that the company already has a relationship with, because there's a lot of less paperwork. You don't have to go through a big giant pain in the butt SEC process, all that Securities and Exchange paperwork. So it's a lot easier, it's a lot cheaper. So a lot of companies, if it's not a ginormous, unless it is a ginormous IPO, a lot of them just go private placement. Now, if it is a really huge IPO, then yeah, they'll probably go public, because it would be worth the expense. You get some economies of scale, right? Because you're going to pay you might pay the same amount of money and go through the same amount of paperwork. But since you're selling so many more shares, it might be worth it, because you might get a little bit better return, initial return on the sale of those stocks. Okay. All right. What else? All right. So a secondary offering. Well, let's back up. There's two different ways to do an IPO also, though, right? So the first time you sell stock in a public offering, you're going to go through an investment bank. That investment bank is going to sell your shares in, again, either as a public offering or private placement, right? But they're going to negotiate a deal with you on how they do it. Either one of those, all right? They're either going to use the best efforts approach or the firm commitment agreement. So best efforts approach just simply mean just kind of what it sounds, right? Like, hey, we are going to give you advice about pricing and marketing these securities. We're going to do our best to find you, buyers for your stock. And we're going to try to get you the best price that we can, but there's no guarantee the company that we're going to get a high enough price for you to get the money that you hoped you would. There's no guarantee. Okay. Now, under the firm commitment situation, the investment bank, they underwrite the issue, the selling, they call it the issue, the issuing of the stock, right? We're going to underwrite it, meaning the investment bank itself is going to purchase all of the shares themselves at a negotiated price. Thus, the company is going to be guaranteed that they're going to get a known amount of funds. Now, the investment banks aren't stupid, okay? They're not going to buy those shares at a price that's going to have them lose money. So, pretty savvy folks, right? That's why investment banks and investment bankers typically make a buttload of money. All right. Secondary offering, that's when you've already done an IPO, but you issue a new set of shares to the public, like 10 years later or 5 years later, whatever, right? And by the way, where would you sell? Here's that test question. Where would you sell both of these types of securities? Primary market or secondary market? The answer is the same for both.
The secondary market?
No. Primary. Primary market, because they are newly issued shares in both of these cases. They're new shares. They've never been traded before. So if it's a new share that has never been traded before, that's primary market, right? That's when you're doing most likely a private placement, or, I mean, you might be selling it publicly, but it would be primary market. Now, once it is sold that first time, and then then they sell it, they're gonna sell it on the secondary market, like the New York Stock Exchange, or on the NASDAQ, or something like that. Some trading platform where you and me can trade it with each other. When you and me are trading stocks with each other on the stock market, that's secondary market. Okay, I'm gonna make sure you guys understand that. So on your notes for this slide, I want to make sure that you write down both of these are sold in the primary markets. Okay, all right. So secondary market trades previously issued stocks, meaning the person who bought it the first time sold it, and now it's just being traded by everybody. All right, that's the secondary markets. All right, so that's going to be on like the stock exchange, one of the stock exchanges, the Dallas Stock Exchange, the New York Stock Exchange, the Tokyo Stock Exchange, the London Stock Exchange, right? That's the secondary. Those are all secondary markets. All right, there's also this weird animal called the OTC. So the OTC market, it's a decentralized market where participants essentially are trading with each other without going through an intermediary, right? You're actually linking buyers and sellers directly to each other through these exchanges. Here's the thing. You can do this by phone or email technically, but it's mostly an automated electronic system nowadays. But it's really, here's the main thing I want you to remember about OTC. And I caution you, if you're a new investor, which you probably all are, stay away from it. Okay, but here's why. You don't know if you're getting a good deal or not, because deals are not made public. You don't know what the market price is, like what it is typically going for. Like, on the stock exchange, it's publicly available knowledge, right? You can see what the market price is at any time of day. Remember, the little ticker that goes across the bottom of your screen when you're on a financial website or watching the financial news? That is the market price. You know what certain shares of stock are selling for. And if the price is going up or it's going down by the little triangle, it's either a green triangle pointing up, and it'll say how much, what percentage it's or what dollar amount it's up today, or a little triangle pointing down, and it'll tell you how many dollars and cents it's down today since yesterday, right? Or since the market opened that day. So you know what the market price is, like what is it going for? But in the OTC markets, you don't. You have no idea. So you might get all excited about some stock that you find on the OTC markets and get in touch with someone who wants to sell theirs. And you think that $15 a share is a fantastic deal, when it turns out most people are buying it for $5. So if you know what you're doing, go nuts. But For new investors, I'd stay away from it. Anyway, there's also ECNs. ECNs are very similar. ECNs, make sure you write this down. ECNs are considered an alternative trading system, an ATS. ATS. Okay, so essentially, it's also connecting buyers and sellers directly with each other. The main difference here is that you can do trades after hours. So in your notes, next to electronic communications networks, write after hours. If you remember that about ECNs, you'll probably get all the test questions right. Any test question about it, correct, okay? All right, yeah, they're not trick questions. All right, let's talk a little bit about personal investing. So personal investing, we're going to talk more about next week, but we're going to introduce it today. All right. So remember, you and I can't buy financial securities directly. We got to go through a brokerage firm of some kind, right? An intermediary. So we go through a broker. Two different kinds of brokers. There's full service and discount brokers. All right, so your full service broker, those are people you can talk to and they give you advice, and when they find a good deal that they think is right for you, they'll call you, like literally call you on the phone and say, hey, we've got, I see blah, 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 shares are trading right now at blah, blah, blah. I think it's a killer deal. From what I've read and heard, it's just going to go through the roof over the next few months. I think we should, you should definitely buy. What do you want to do? And you'll say, oh, well, okay. You know how much money is in my account. Why don't we sell these securities and I'll give you, I'll deposit a few more dollars and buy this many shares of it, right? So that's a full service broker. They can talk to you on the phone and give you advice, and you can put in different types of orders like, hey, if it reaches this level, buy it or sell it. If it goes down to this level, let's cut our losses and sell it, right? So you can do that with a full service broker. They'll give you advice. They'll try to take care of you. They make money when you make money, but you know what? They also make money quite often, even when you lose money, because some of them charge you fees for every trade, whether you make money or not. Okay, but obviously they want to keep you as a customer, so they're going to do their best to make you money. All right, but discount brokers, not so much, right? You're not going to talk to anybody, most likely. Might be able to. Like Ameritrade kind of tries to walk the line, for example, between a full service broker and a discount broker. But most discount brokers just non-made like a website or an app on your phone. That's a discount broker, right? You can go to like Ameritrade is technically a discount broker. You can go there and set up an account in probably 5 minutes online, link it to your bank account so that you can transfer money from your bank account into an investment account, like a pool of money, like a bucket of money that's sitting out there ready to be used to buy securities, right? So you set up an account, and then you can look all those websites and even the apps on your phones, they have all kinds of research available for every stock that you might be interested in buying, or mutual fund, or bond, or ECN share, or floundering today on that word. What is it? Anyway, those are discount brokers. You're not going to get any advice, but they have a lot of information that you can do research yourself, kind of a do-it-yourself. All right, and then robo-advisors, they're kind of new and kind of interesting. In fact, let me show you the ones that are mentioned in the book real quick. All right, so one is called Wealthfront. These are kind of interesting. So this is essentially like, I guess I would liken it to an automated full service broker maybe, but it's all automated. It uses algorithms. So essentially you go in and you set up an account and then you answer a whole bunch of questions about your age, how much money you make, how much all your bills are every month, what your short-term financial goals are. Like, I want to buy a new car in 2 years. I want to take a vacation in Maui for my 20th wedding anniversary coming up in 5 years. I want to buy a house in 10 years, or I want to retire at age 68. Whatever, you answer a ton of questions, right? And then based on how you answer those questions and how much money you currently have and are going to have every month to invest, it will automatically go in to your bank account and grab money you are not using. I mean, set to limits that you are in control of, obviously. But we'll go in and grab that money, any extra money you have at the end of each month, and it will invest it for you based on how you answer all those questions. So kind of cool. I mean, the reviews I've read seem to be pretty good. It even will create a lot of paperwork for you to, all the paperwork for your taxes on all your investments. You got to pay a tax on capital gains, unfortunately, but it's kind of cool. And then Betterment is kind of this, it's exactly the same thing. It's just a different one, right? You answer a bunch of questions and it grows your money for you every month. I mean, even if you only have $100 to invest at the end of every month or whatever, right? It will do it for you. It's kind of cool. I mean, I dig it. I think it's kind of a cool idea. Just so you know, there is a difference between a broker and a financial advisor. Okay, we'll talk about what a financial advisor is next week. All right, so let's talk about some basic strategies. All right, so obviously you need to know what your short and long-term goals are. I want to, maybe here's one for you for free. Maybe as you graduate and you get your first whiz-bang job, you know what I think your first short-term goal should be? Get out of debt. Get out of debt. Maintain your current life, your current poor college student lifestyle until you pay off all your student loans. All of them. Done. Live like no one else so that you can live like no one else, right? You stave off that immediate gratification, right, until you get out of debt. Maintain your poor college student lifestyle. I know it's easy to say and hard to do when all your friends are buying new cars and new toys and getting really cool apartments, and you're still living in a crappy college one and driving a beater. But trust me, it will be worth it for you. So you're going to figure out what the goals are for you, right? Another one is what your budget is. How much can you invest? Now that's kind of a loaded question, though, isn't it? Because we all like to spend money, don't we? I love to buy toys, guns, ammo, cars, go fast parts for the cars, cool stuff from my garage. I mean, whatever your thing is, we all like to spend money. But think about your longer term financial health. Think about not being stressed out by money. With some financial discipline, which again we'll talk about next chapter, you can be free of money stress. We'll talk about how to do that on Tuesday. But figure out how much you can budget. And I would tell you, you need to force yourself to use some discipline here. Like, hey, I don't have to go out to eat this many times per week. I don't have to, I can curtail a lot of my discretionary spending so that I can invest. All right, and a financial advisor, by the way, will help you figure that out if you go that route. How long can you leave your money invested? I mean, is there a time where you really need to pull your money out? For example, I am 52 years old. I'll probably work till I'm, I don't know, 65, 66, 67-ish. And then I'm retired. So my money is only going to be, my money is going to be invested for, I can't do that math, a few more years. And then I need it. I need it to be making me money. Now, I still may leave it invested if it's giving me a regular income. We'll talk about that in a second. What about tax implications and what's your risk tolerance? Remember that curve that's like this, right? So there's investments down here on the curve that are super safe. They also don't make you that much money. The investments up here that can make you like a whole bunch of money, but they're also riskier. You can actually lose a lot of your money that you're investing in those securities, right? So here's something to consider, just kind of timing wise, basic strategy, right? When you guys most of you guys are pretty young, right? So for example, I talked about participating in your company's 401k. So when you participate in your company's 401k, they're going to automatically take out maybe 5, 6, 7% of your paycheck every month, and they're going to put it into different funds, mutual funds, for your long-term investment. You're building wealth, right? You're not just your retirement. I mean, you're growing your wealth for whatever you need, but it's long-term, right? So you have your choice amongst a whole bunch of different funds, and each of those funds will be in a risk category. Most companies make it really easy for you, right? They'll go to some sort of financial services company to set this up for your company's employees. And it'll say like there'll be different bands. A lot of times there's like 3, let's keep it simple and say that there are 3 risk bands, right? So on this side, it would be the investments that are really safe. They don't typically make a whole lot of money, on average, but they're really safe. Then you may have a few funds that you can choose from that are in the middle band that are kind of a medium amount of risk. They make pretty good money, but they're a little bit more risky. And then maybe you've got this third band that on average makes quite a bit of interest, but some years it tanks for a while, right? Okay, so think about it. When you guys first graduate, if you're pretty young and you got a lot of years ahead of you, working years ahead of you, heck, you can afford to have a great percentage of your money in those riskier funds because you've got time to ride out those peaks and valleys, right? You can, because remember, you only lose money on an investment if you sell it for less than you paid for it. If you buy into a mutual fund that tanks, that's not the time to sell it. It's the time to hold on to it until it goes back up and keeps making you money again. Like my retirement accounts and my wife's right now, this second, I mean, they tanked like everybody else's, right? But we haven't lost money because we're not selling it. Does that make sense? Okay, so if you're a new graduate, you're probably going to put maybe 10%, 15% in those really safe funds. And then you're going to put maybe, let's say you put 10% here, maybe you put 40% here, right? And 50% in the riskiest risk, the highest risk level. Because, hey, why not? You've got a lot of time to ride out peaks and valleys. You might as well take advantage of the really high returns. Whereas I I'm 52 years old. I'm going to work for another, 18 years or so, however old I'm going to be. So I'm probably going to have most of mine in that middle category, right? Like I might have 20% here and 60% in that middle category, and the rest in the high, a little bit in the highest risk. Does that make sense? So mine would be kind of a flip-flop of yours as the younger person. So that's kind of what we're talking about. Like, what is your tolerance for risk? Also, I will tell you this about investing. It can be really fun if you get into it. Like one of my wife's cousins, he's really into it. His wife is somewhat, but he's really into it. Like he's a member of an investment club, and they actually meet and like they all do research before each meeting, and they get together. It's like fantasy football, but for making money. And these people are into it. And they get together and invest their, decide kind of as a group how to invest their money, and they make a killing. They always, my cousin, Michael, his group always does better than the market. I mean, they do a really good job. So it just kind of depends on what you're into. As a new investor, I will also tell you though, that don't get freaked out and watch your money every second, because remember, the nature of the economy and therefore of investments is peaks and valleys, right? If you buy up here and you watch your money every second, you log in every day and look at your mutual funds and they're down, don't freak out, and definitely don't sell. That wouldn't make any sense. Write it out. All right. So a couple of different ways. Let's say that you're going through, you're investing on your own, or you're going through a broker. A market order is when you tell your broker to buy or sell a security at the best price currently available. By the way, when you buy a stock on the secondary markets, on the stock exchanges, online, you are placing a market order. If you buy it, hey, I like that price, I'm going to buy it right now. That's a market order. It's the best, because what you're seeing on the exchange prices, if you're going through a regular exchange like most of us, the price you see for a security is the best deal at that moment. So if you buy it, that's a market order. Now, a limit order, that's when you're calling up your full service broker, or you're doing it electronically on your discount broker website, and you're saying, hey, I own this stock, and if I'm trying to make a capital gain, so if I bought it at $15 a share, if it goes up to 25, you're doing your research and you think that's going to be about as much as it's going to get up to before it starts dropping again, because they always go up and down. You might put in a limit order and say, hey, when this stock that I bought at 15 gets to 25, sell it. And I'll take my capital gain and I'll be super happy. By the same token though, you might go, you know what? This stock I bought at $15 seems really volatile. It was up at 20 for a while, and this just seems like it's racing down right now. There was some, they released their earnings report and it was terrible, or their competitor just came out with some whiz-bang new, product, and it seems like it's barreling downhill fast. Man, if it gets down to 13, just sell it. And I'm gonna cut my losses. It's a limit order. Okay, and you can do that by phone with your full service broker. You can probably set it up electronically on a discount broker website. All right, so there's a few ways, different people have different needs for how they invest. Old farts like me probably investing or getting close to investing for income. That's when you're like, you know what? I'm going to focus most of my investments. I'm going to take them out of mutual funds maybe and put them into bonds and preferred stock so that I get that steady, predictable income. I just want to be able to pay my bills. You know, I've accumulated as much wealth as I'm really going to accumulate, but I don't want to just pull it all out and stick it in a bank. I want to continue to make some money off of this nest egg that I have saved for and invested for my whole working career. I want it to just give me a steady, stable income. So I may put it into preferred stock and bonds and just get that predictable, steady income. Another thing is market timing. That's when you're using those analytical techniques to try to predict when prices are of specific stocks are going to go up or go down. Think about it this way. If you're looking at a stock and you're looking at the history of it, you know, you do a search in Google and you on a certain stock, and you're always going to be able to see a historical sheet. And sometimes you can change it. You can see the last today, this week, the last year, the last 5 years, last 10 years. You can start seeing patterns. Like this time of year, it seems like this stock really ramps up. And then at this time of year, it seems like it gets really, really low. Well, obviously, you'd want to buy when it's low, and then you would time your sell of that stock when you think it's going to be up or when it's at its peak. Does that make sense? So that's market timing. You can also do market timing on wildly shorter time horizons, like the day traders I was telling you about, right? You can buy a stock in the morning, and when you think it's at its lowest, and then if it seems like it always hits a peak, and you're using software that helps you figure this out, it always seems to hit a peak at about 2:05 every day. So you can, you know, watch it, and you're watching the little graph or the numbers, and you're like, sure enough, it looks pretty high. It's 2:05. I think that's about as high as it's going to go. Boom, you sell it. Make your capital gain, right? So using the timing of the markets, either in the long term or super short term. I would steer you away from the super short term. You'll lose your shirt. All right, you can also invest for growth, right? You're looking for companies that have a potential to grow a lot faster than average for a sustained period of time. So, you know what? In your daily reading of the news, especially maybe the business news, Fox Business, CNN Business, Bloomberg, whatever, right? You should be at least perusing the headlines, clicking on a few articles every day, okay? So anyway, let's say that you're doing that and you come across some company that you think sounds like they're really promising, like they're developing this new way of doing this, or they developed a new product that does that, whatever it is, right? Or they seem like this company you read about seems like they're on the verge of, you know, something super awesome. Well, hey, you might want to buy them because they might be really about to take off. So you want to buy when it's cheap, like right before this wonderful thing happens, and then use some timing, right? But you're investing for growth. If you think this company is really going to take off, buy it early, hold on to it until it's really going gangbusters years later, and you can make a ton of money. Okay. Value investing is kind of to me, is kind of a silly thing to have as a strategy. Not because it's not valid, but because that's what everybody tries to do. You're trying to buy low and sell high. You're trying to find stocks that are undervalued and buy them in the hopes that people are going to figure out that this is a worthwhile company with good earnings, and then everybody jumps on the bandwagon and the price, you know, isn't as high or goes way up rather, and then it would be expensive to buy. So obviously value investing, you know, everybody and their dog is trying to value invest. But buying and holding. I would tell you that any good financial advisor, probably not a broker, because a lot of them make money every time you do a trade with them. But a good financial advisor would tell you the best strategy is to buy and hold. Don't buy and then freak out and buy and sell all the time and all that, you know, stress yourself out. Buy stocks, hold them for the long term, because over the long term, you're probably going to get a pretty nice return on your investments. And remember, you've got the power of compounding. So, you know, if your investment grows and the more money that you have, the faster it grows. So if you guys start investing right after you graduate, you get your first whiz bang, fantastic job. You start investing in the company's 401k, and you'll be buying Roth IRAs. Every month you'll be putting money into that. And we'll talk about what that is next chapter. And then you leave it the heck alone. Maybe every year, you're going to get a reminder from your company's 401k program. You're going to get an email and say, hey, it's time to review your accounts. You can log in and look at your different accounts. And you remember those percentages I told you about of risk categories? That's your time every year to play with those and say, you know what, I'm going to move my percentages around a little bit, or this fund doesn't seem like it's doing much. I'm gonna take my money, leave it in the same, maybe the same risk category, but I'm gonna take my money out of this fund and put it in this one. It seems like it's doing better. Okay, and that's all the jacking with it you really need to do. Just then hold what you got. Keep on putting money into these every single month, right? On every single paycheck. And tweak it a little every year, but hold on to it. Don't spend that money. That's the buy and hold. If you do that, by the time you are my age, be a millionaire, right? By the time you hold on until you get to retirement age, holy crap balls. Maybe you can retire at 60 years old and travel the world. Do whatever you want to do. Buy a race car. Play golf. Go to shooting schools. Whatever you're into. Okay, that's buy and hold. All right, just very, very quickly. I'm not gonna spend a whole lot of time on this, but just so you know, just kind of, if you want a really quick indication of how well the financial markets are doing, you can look at the Dow. Don't say Dow Industrial Average. You want to be cool, right? Say the Dow. Right? That looks at the stock prices of 30 well-known U.S. corporations. So that's a really quick way to, at a glimpse, to see how we're doing. Remember the Dow right now is like 23,000. Hey, it's bounced back pretty well already from this whole shutting down of the economy, essentially. It's doing better than. I think it's snapping back because investors are thinking, hey, you know what? I think our country is going, our economy, the world economy at large is going to recover. I think we're going to get through this. And so I feel better about, spending some money, keeping on my investments, buying more investments, right? More stocks. So the Dow is a good indicator of that. When times are really, really bad and the economy is doing poorly, people aren't spending as much money in investing, they're spending their money on surviving, the Dow is going to go down. And that's an indication that the economy is not doing as well. So it's a good way to also know if your investments, like your 401k investments, are doing well or not. Take a look at the Dow. The S&P 500, kind of the same thing, except it's looking at 500 major companies around the world. And then I don't expect any of you guys to memorize all these. I would definitely know these just as general business knowledge. Every human on earth should know these, every American at least, and know the NASDAQ. I don't really care if you memorize any of the other ones, but you need to know the Dow, the S&P 500, and the NASDAQ, and understand what it is. Again, it's just kind of a good snapshot of how well the economy is doing. All right, here's how to read. We'll finish off with this. This is how to make sense of stock quotes. You know, you get excited, you hear that some company is a good buy and you want to check it out yourself. When you look that stock up, it's going to give you all of this information. So here's what that information means. Okay, so last trade, what's the most recently, what's the latest price it traded for? If you are looking at the stock on one of the exchanges, which that's probably what you're seeing when you go to a trading app, right? Or your favorite investing website, you're looking at the current market price is what it last traded at. Also the change, that's the price difference of the last trade from the closing price of the stock the previous day, which is also the same price as it is when the market opens. You can say it either way, right? Bid and ask is the highest price currently being offered to buy the stock and the lowest price currently being offered to sell the stock. Now, that primarily is going to be happening on the exchange floor. And as a regular investor, I don't know that you really need to worry about that. But it just might help inform your decision, though. It might just kind of help you know, like, well, what seems to be the fluctuation, what people are asking and getting for this trade. But not super important to me. The days range, now, I think that is really important. And I'll tell you why. Essentially, what it does, it tells you the highest and lowest prices the stock sold for today. Here's why I would pay attention to that if I was looking at buying a particular stock. And then again, this is like when you're buying and selling individual shares of stock, which is fun to play with, but I wouldn't do it as an investment strategy. Okay. We're talking about individual stocks. So if you decide, you've done your research and you decide to buy a particular stock, hey, now I would be looking at what's the best time of day to buy that stock, right? Let's say that you decide to buy AMC because it's a movie stock and you know it's really low right now because everything's closed down, but you think, hey, I think it's definitely going to go back up when the economy recovers, so I'm going to buy it, okay? So now I would look at the day's range and figure out, okay, is there a time of, it's trading for about $3.20 right now. Okay, well, is there a time of day where it seems to be at its lowest and a time of day that it seems to be higher? Well, obviously you want to buy it at its lowest. So you're trying to squeeze every single penny you can out of that investment, right? So I would get online and look at the day's range real quick or the previous day and go, well, it seemed like it dipped at its lowest point at 11 a.m. So I'm going to log on today and about 11 p.m. see kind of where it's at from the change from yesterday, and then buy at that time. So you can also look at the 52-week range, right? If you're thinking about buying a stock but you're not sure, look at the range. You're like, well, this time of year seems like every year it goes up to this level, and every year around this time of year seems to be pretty low. That will help inform when you want to make that purchase. Volume is the number of shares that have been of a particular stock that have been traded to this point in the current trading session, as in today. You know, the market opens at 9 and closes at 3. So that's the trading session. So volume gives you an understanding of how active that stock is. Usually that's an indication of something is happening at that company. Either it seems like it's doing really, really well, or it seems like it's sucking eggs, right? Something is usually happening when the volume is really high. So it's something you want to pay attention to if you're thinking about buying it or you already own it. Market cap is simply the total market value of all of the shares of a particular common stock. You add up the value of current market price times the number of shares there are out there. That gives you the market cap. And then PE is the stock's price per share divided by its earnings per share. Price per share, so price divided by earnings per share. So the higher the PE ratio means that investors expect a higher growth rating, growth in earnings over time, higher earnings growth over time. I will give you two more: earnings per share, which is simply net income available to common stockholders divided by the number of shares of common stock that are out there. Obviously, you want to know what kind of earning, what kind of return on investment am I going to get for every share of this stock that I buy, if I do. And then if you already own it, you can see how well you're doing by looking at the earnings per share. And then dividend and yield. So if you take that's the sum of the dividends that are paid out over the last 12 months per share. So this gives you the percent return or yield. So the yield part of this is essentially you're taking the dividend per share divided by the previous day's price per share. Okay. All right. That's it. That's all I got. All right. So make sure you guys are tracking on all of these terms. Please, please, please. Okay. Make sure you read the chapter, every chapter at least twice. When you read it that second time, use that metacognitive technique where you stop and pause after every paragraph and recite what you learned in your own words. I would review your key terms every day and read your notes. Make yourself a good cheat sheet. If you do that, you guys are going to rock this test. I know you can. All right. So get to it and have yourself a great rest of your day. See you guys next time. Take care.
Bye.
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 Bye.